Okay, we are live. The video did
Wait
not
a
play.
second.
It didn't
What the
play. Hang
heck?
on. No, just a second. Wait a second.
Something is very wrong.
Hang on. Wait, I know everyone wants it. So here it comes.
It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
Yeah, take that.
Did you turn that off, John?
I did because we record our weekly updates in this studio too, and it's set to always play. So instead of having to play it and then have the editors remove it at the end, I thought, why don't I just not play it for that one since we don't use it?
Everybody loves it. Just look at the comments. Everybody
like
loves the intro. Thank you,
nice.
people.
That's what I'm talking about.
Change it up. All right. Good morning, everybody. Good morning to you, John Walkup. I am Noah Rosenblatt. Oh, good morning, Johnny. Good morning to you guys. Thank you guys for joining us. We're getting close to the holidays. We only got 1 or 2 more Macro Mondays left. Let me go actually to the calendar here. We got today. Okay. Tomorrow, we're going to do a session on our advisor, live Q&A on this new advisor service we got if you're interested. And we got 1 more Macro Monday, guys. And then we're going to call it quits, I think, until the end of the year. Maybe we'll do a year-end review.
Well, look, this is the 8th, then it's the 15th. Then it's the 22nd, 29th. I don't know if we'll do ones on the 22nd, 29th, maybe the 22nd. And then it's January 5th. We'll definitely be back for January 5th. How is that?
Yeah.
How is that possible? 2026 is around the corner. It's not even around the corner. It's like reaching out its hand to say, hey, welcome to the new year.
Hey, we need to
say, I don't trust you. Stranger danger. It's here.
All right. Well, we'll figure out whether or not we'll do a year-end review if you guys want to do like a live chat over there. But yeah, let's get going, guys. It's Monday. Get a little Macro Monday coming right at you. For those of you that are new to the show, we're going to start out with Manhattan real estate. I got it up right over here. We're going to go to a bunch of macro topics, and we'll circle back to Manhattan real estate, and we will try to do this in 30 minutes or less. Year-end review. Our year-end views. I can't even talk, John. Year-end review is getting good thumbs up. The idea for a year-end review. It's like a tongue twister for me. By the way, are you there? Am I talking to myself? Hello?
I'm typing in the comments. Of course I'm here.
All right. Let me go back to the intro because I totally messed this up, guys. The important stuff, nothing what I say or John says is financial advice. Do not go start day trading that stuff. Okay, we'll talk about credit spreads. We'll talk about the Fed fund futures. But first, look at Manhattan real estate, John. Look at Manhattan real estate. 1 month market snapshot, guys. Supplies at 770. We're going way, way down. That's supposed to go down to 596, John, by the end of this month. So fall off the cliff, pull the rug. It's going down.
Yeah, it is a rug pull. The thing is, when you look at that liquidity, right, you can see that drop on the contract sign number. I'm jumping ahead because this is the number that's important to me. And it's visually striking. And I think one of the things we talked about last week was like, wow, hang on, it's a calendar thing. And it is. There's a bit of that happening. And always Monday is usually the low part in our liquidity count. But, I mean, look, typically you drop from November into December. And we've talked about how the back half of November is usually a lot worse than the first half of November. And then you enter December, it doesn't really build on itself. It deteriorates as you go forward. And we're certainly seeing that in real time. So the number of contract signs has really rapidly approaching its seasonal quiet period here.
Yeah, well, contract signs at 724. And that's, as you said, that's going way, way down. 774 is our norm. And we're at 724. And I can't imagine the next couple of weeks is going to have a ramp up of contract activity. So it just looks like, we got to still see your screen is fuzzy. Yeah, you know what? I mean, some stuff is a little fuzzy. It is. I don't know why it shows that way, but this is the best we got. Okay, Dorothy. So hopefully you can still read the concepts. The main concept here, guys, look what I just highlighted. Okay, that is basically what we're talking about here with liquidity at 724. Take a look at this fall season, how we just kind of fell off the cliff. Take a look at last year. It was a little less of a slope. And then, of course, 2 years ago, which was right in the volume trap era, that was just brutal. So we're doing better than that, but it was a quick regression. We were doing great up until about 3 weeks ago, and then it just went straight down. So,
yeah. So, I mean, there are historical precedents. I mean, usually you see this 25 to 35% drop off from November to December, it's totally normal. It just kind of looks striking because I think Thanksgiving ended at, last day of November. We kind of rolled right into the quiet period. But I think when you look back at the great financial crisis, that was like mid of the spring period. That was like May into July, basically. That was like a 40% drop. I mean, it was just like right off the bat. COVID was a huge hit. That was like an 80% drop right off the bat. So these are really horrible examples to compare to, but I'm just saying
they're pretty bad.
It looks sharp, but it's nowhere near as sharp as some of the ones we've had. But it is not even remotely close to those. But it's quite normal to see this drop into the fall.
It is. It's just a quick, sharp drop. All right, let's pivot.
Someone take his internet away.
I'm sorry. How do you not love that?
Gifts.
Oh, come on. I hope that we got a whole bunch of memories going on. I mean, we're all Gen Xers here. I mean, or I guess, I don't know. I mean, I feel like that, whatever. A lot of us could relate.
People love it. People love the Friends references. It's good. I like that too. I remember that scene.
Pivot. You said it last week. I had to put it up. All right, let's go pivot to macro portion of the program. We're trying to make it fun, guys. We're trying to make it fun. That may show its face a lot. We haven't seen Simon in a while.
Simon might show up.
Simon might show up. Guys, credit spreads is our canary in the coal mine. It is our warning signal. It is our fire alarm, guys. It is our fire alarm when this blue line goes up. I'm reading the comments here. When this blue line goes up, okay, I'm going to click max. Okay, when the blue line goes up, very, very bad things are happening. Risk off. People want their money back. They don't want return of their money. They're not searching for a yield like they are now. They're searching for yield now. They don't want to own dollars now. They want to own risk assets now. It's risk on. Okay. When this goes down, risk on. When this goes up, risk off. Think about that. It's the credit markets, and it's been doing nothing but pretty much coming down since tariff time. And I don't see anything here, John, that is a warning sign. So
no, this chart, I mean, you know me, I like to look at this chart. We created this chart from scratch. It's our baby. I love it, but it is a super boring chart, especially when you zoom out and you're looking at like max, you're looking at that, because most of the time, 99% of the time, it's just like snooze fest, watching grass.
That's how it is.
But when it starts rising, that is white knuckle pure panic. So it's always nice to kind of get a sense for like, all right, well, do I need to be thinking about something here? Right now, the answer is no, not really. Like, things are kind of going, but zoom out, you're okay. Zoom in, it's a little bit flat.
If you've ever asked yourself before, like, I wish I knew when the big one's about to hit or whatever. This is one of those, well, this is how you know. Okay. And right now there's nothing going on. So we're going to move on to that. Nothing going on in credit spreads. Fed fund futures, however, there is a Fed meeting Wednesday. December 10th is the Fed meeting. Here's what you guys need to know. We are here, 375 to 400 basis points. Right now, 89.6% market expectations. We go a quarter point. Each one of these is a quarter point, guys, these little table things, to 350 to 375. That's already priced in. It's already priced in. So don't expect mortgage rates to fall if this happens, okay? In fact, mortgage rates might go up depending on the statement. Remember what we said a long time ago, guys. It's less about the cut itself, more about the forward statement that's going to drive all this stuff here. Okay?
Exactly. Yeah. I mean, this is, I think this is really the crux of the matter. I don't know if you have the mortgage rates up on there somewhere. Is that
I
it?
got it.
Yeah. So you look, we're in a sort of an easing cycle, and mortgage rates they've certainly come down from their peak, but they really haven't come down as much as you would expect. And a lot of that has to do with the fact that this is one of the rare times in history when we're in a Fed easing cycle, and the 10-year, which is where mortgage rates are based off, have essentially gone up. They've gone sideways. So I think we have a chart on that. Noah, do we? Yeah,
we'll get there. We'll get there in a second.
Okay. All right. I'm jumping ahead. I'm pre-pivoting.
You're pre-pivoting. You're pivoting too fast. All right.
Don't let me pre-pivot.
Karen's asking, what about quantitative easing? Did I say that right? You did say it right. You have to understand QE and quantitative tightening, QT, is the Fed basically either printing money or taking money out of the system. Think about it that way, right? Reverse money printing. Think about that. That's quantitative tightening. We've been in that. We've been in the reverse quantitative tightening, pull money out for a long time because they're trying to get inflation under control. So they've been removing liquidity. I believe they're about to stop that QT, which is not necessarily the same as QE. They're not going to go start money printing again. They're going to save that playbook for when shit hits the fan. And when credit spreads go up, when credit spreads go up to here and these crazy levels, that's when they do QE and they stimulate the market. So for now, this is pure just interest rate moves. And what the market thinks the future interest rate moves are going to take us. That's all is going on here. Okay, let's not overplay it. There will be a time, though, to overplay it, and we'll talk about it. It's just too early.
Good point.
Yeah. All right, John. Go back to your point that you wanted to make. I think you were talking about.
Well, I have to de-pivot and go back. So the idea I'm talking about is this is a great chart that was on Bloomberg over the weekend. The idea is that there's a raging debate in Wall Street right now, which is like what's happening with rates, what's happening with the Fed versus rates, and this chart kind of breaks down everything in a visual way, but it's kind of hard to read. So I'll try to walk you through it. So that the gray bars there, right? These are the recessions, right? So let's just put that aside. The black bars is how much the Fed funds have changed during the easing cycle. The blue one, we're talking about mortgage rates here. That's our end goal. The blue one is how much the 10-year has changed during that easing cycle. So you can see.
So these are all rate cut cycles. All rate cut cycles. Okay.
Rate cut cycles. And typically what happens is the 10-year kind of follows it down a little bit, right? The idea is that the Fed is trying to stimulate the economy by pulling down rates, and the 10-year kind of follows that down. Here we're not seeing that. We're actually seeing an increase in the 10-year since the easing cycle has started. So that's an interesting thing. And I guess there's a couple ways to interpret that, right? So, I guess there's multiple ways to interpret it. The question is, should you worry or should you not worry? Like what's going on? But essentially what's happening is that, to your point, Noah, it's not about what's happening with the Fed right now. It's about the future outlook. And the question is, and we talked about this last week, is the Fed going to be focused on fighting inflation, which is still coming in above its target? Or are they going to are they reducing rates because they want to stimulate the economy? And I think right now the consensus is that the Fed wants to fight inflation. It's not about stimulating. It's about keeping the economy as it is going. So they're more or less sort of, and this is why we're not seeing a lot of movement in the Fed funds. We're just sort of keeping this narrow rate area because they want to keep the economy going. The result, though, is that the longer-term traders are looking at that and say, well, look, we're going to need a little bit more money for our risk here. So they're starting to add on to that. It's kind of called a term premium, starting to see that. And what's happening is that 10-year is starting to rise. So mortgage rates, even though, long story short, John, even though the interest rates are coming down, mortgage rates are ticking up or going sideways now because that 10-year is essentially not moving. And I think we have a chart of the yield curve from this month, last month, and last year. Do you have that one handy for me, Noah?
I accidentally deleted it.
Okay, there you go.
I'm trying in the background to get it up. There we
go. That's it. So the green one is the yield curve last year. The blue one is it right now, and you can see where they all meet at fulcrum point is the 10-year. So you can see how far that front end has dropped.
Okay.
Yeah. Everything's dropped. Those interest rates in the short term have really dropped, and all through the curve except the 10-year, which is staying super fixed in time. And you can see how the longer ones, even though the interest rates dropped, the longer term rates are higher simply because the trading end, which is set by traders, and to your point, that future outlook on risk is higher. It's like, all right, well, we think that the government's printing too much money. They're going to owe a lot of money. We want to charge for that. So that's kind of what's happening at the far end of the curve. But right now that 10-year is just stuck in time, essentially.
I mean, it's a very high level session you just did there. Very, very high level.
Too much.
Confused. If you guys are confused, don't worry. I'm confused myself. Okay, but let me just try to understand what you're saying, John. I want to just dumb this down, right? And talk to me like I'm a Labrador right now. What you're basically telling me is that the 10-year yield, this yield right over here, is not really moving down as the Fed is lowering rates like it usually does in the past. So the Fed does not control the 10-year. The Fed controls the shorter end of the stuff, the earlier stuff. But the 10 years too far out, the market's kind of doing its own thing. So now here we are. The Fed's about to cut rates again. And John's trying to tell us, be careful, guys, because so far, when the Fed's cutting, the 10-year either stays where it's at or goes higher. Is that what's going on here?
Yeah. And there's basically, there's three ways to look at this. There's the optimistic one, which is like, the Fed's cutting rates without a recession, right? That's basically things aren't crashing. Things are great. Then there's the idea that we're just returning to normal. Like, hey, look, before 2008, 4% rates were like a thing. We don't need to cut rates. We're back in normal territory. And then you have the bond vigilante, sort of that pessimistic interpretation, which is like kind of losing a little bit of confidence in the U.S.'s ability to sort of manage its debt here. So we want to charge a little bit more. Yeah. I don't know which of these outlooks is correct, but I think that's what's happening right now. These are sort of the mindsets right now that are playing out through both on the Fed side of the table, which is trying to manage the economy and of the rates, and on the bond trader side of the table, which is managing the longer end of the rates. Mortgages are caught in the middle of this right now.
Interesting. All right, so let's just focus on the Fed aspect, the Fed side, not the bond market side. The bond market's the bond market's the policeman of the markets kind of thing. They're just making they'll make sure things happen even when they don't. All right, are a little tricky. Guys, inflation. This is what you need to know. We talked about this. I want to reiterate into your brain what's going on with the Fed because it relates to the Fed, and we'll just tell you what you need to know on the Fed fund futures. Inflation is down, but is just lingering above this target. It's just not going down. It's just sticky. That's what that shows you. The job market, it's just tough out there. All right, non-farm employment, non-farm payrolls. It's just been really, really a tough labor market going on there. So you got the labor market softening, weak. You got inflation sticky, but down, but above target, and the Fed's caught right in the middle. And you got the bond market over here, and you got the Fed over here. We're looking at the bond market through credit spreads. That's the bond market, guys. That's the bond market right there. And we're looking at the Fed through the Fed watch. You understand? So hopefully now you understand why we're doing this. Bond market, Fed watch, right in between. That's what John was talking about for the last couple of minutes. And what you need to know is we got a cut coming 90% on Wednesday. The next cut is not until April, and that's 40%. And what do we know from this show? It's too far out, and it's below 50%. May not even happen. We're not going to talk too much about it. Okay? Don't give bad information. Just talk about the one cut that the market's expected and priced in. That's all you need to know. Okay. Go ahead, John.
No, I was going to say, but when you look at the markets, and I'm not talking about just the equity markets, right? The S&P is a broad measure of the equity markets. The consensus amongst the banks, thank you. The consensus, though, is that this not only, if you use this as a measure of the economy, the consensus among most of the larger banks is that there's more upside here.
Yeah, keep on going. Keep on going. Well, I mean, if the Fed is normalizing and there's this growth, and then you got the labor market and you got inflation, all you need is a couple of good prints on one or the other. It could move the markets either way. If the jobs market somehow stabilizes or doesn't deteriorate as much, the market's gonna be growing. So you got these optimistic forecasts. I know this is fuzzy, guys. You have to understand when I get these charts, they're small. We got to pump them up, and it loses resolution. That's why it's fuzzy on this. I don't make these charts. I find them for you.
Do you happen to have the Hans and Franz pump you up gift? That would be
I don't have the Hans and Franz.
Pump you up.
Thing.
I'll just act it out.
Those are the days. No, the point of this is that they're still very optimistic. They're optimistic on Wall Street that this thing continues and that this thing grinds higher. And when I'm looking at credit spreads, guys, I don't see any reason why that's not going to come true. There's no reason for the market to go down right now. Unless, I don't know what's going to happen tomorrow and next week. Nobody knows. But as of right now, what we're seeing, it's risk on. And risk on means search for yield, risk assets.
Yeah, well, and now we didn't rehearse this, so I'm just going to jump in with a quick interpretation of what I'm looking at here. And there is something we can actually think about, which is this chart basically starts in 2024. You see 2025. That vertical line is Liberation Day, all the way down, all the way back up. What does that mean for this market, the Manhattan, the Brooklyn market? That means that Wall Street bonuses are going to be what's the phrase these days? Off the hook, off the chain. They're going to be nuts. They're going to be nuts. Wall Street bonuses are going to be nuts. Now, these are likely not going to be apartments that are trading under 2 million. These are going to be likely 2 million plus apartments that we could see a bid come in for these as soon as this month. Frankly, you could start seeing some people who have a great idea of where their bonus is going to be, like out shopping. So hopefully this is enough to kind of get Manhattan past the mortgage wobbles that we're seeing, where mortgages aren't really enticing people off the sidelines for the under 2 million properties. But that luxury market could keep going, and we could have hopefully, I'll keep my fingers crossed, hopefully an interesting spring season ahead.
Yeah, interesting. John, I'm curious what you think about Roberto's comment here. It seems like we are front-loading this economy a bit, trying to nudge growth on the short end, but the market is more cautious and compensating by allowing the longer-term rate to float up.
Yeah, I totally agree with that. I think that's to the point that you're making earlier. The Fed is caught between a rock and a hard place, right? You were showing like payroll growth is sort of non-farm payroll growth is really sort of stagnating here. At the same time, inflation expectations are well above target, and they've been above target. So, the question is, how do you get out of this trap? And, right now the Fed has been, opting to sort of front load it by lowering that rate. Obviously there's a lot of pressure from the executive branch to have some dovish folks in there to keep those rates lower. But at the end of the day, right, you want a rate that reflects you want a neutral rate. And I think we're trying to figure out what that neutral rate is. But right now we're erring on the side
probably close
stimulus.
We're probably close. Yeah. We're probably like, a quarter or half a point away on the upside. I've got to go down a quarter or a half point down to get to that neutral rate, in my opinion. But we'll see. Somebody's asking, could you please repeat why Wall Street bonuses could be high? Well, I think John's just thinking outright stock market returns. Right, performance. There's been
an enormous amount of volatility in the markets, and so you have markets going down, up, and just a lot of whipsaw. You have crypto whipsaw. You have all kinds of, and it's the trading desks that are just making lots and lots of money. And it's aside from the banks, you also have some of the more algorithmic desks like Jane Street or some of these folks that are active market makers. They're just like cleaning up this year, and so you just this volatility is spreading wealth across Wall Street.
Yeah. Yeah, traders love volatility. They love volatility. Very, very interesting. Could be a setup for a really good. Are you going to write a piece about that in Forbes?
I might. We did that like a year ago, 2 years ago. We wrote about expected bonuses. Usually, what happens is the comptroller comes out with what they expect bonuses. I don't know if they have that out yet, but it will keep you posted.
Cool. Meanwhile, if we want to touch one housing element right over here, I don't. This is not one of those things that it's like super critical for us to know. It's just like throwing something out there. Like, oh, okay. Now I have a reference point of something. But, the MLS data across the country tracks broken contracts. We track broken contracts too. John, I believe you did a little nugget of Manhattan or New York City digging there, but it's 15% and on the rise. Is it high? It looks like we're in a channel over here, but it's good to have a general idea of what that is. I'm going
to do a full-on Honey, I Shrunk the Kids. We're going to shrink down. We're going to go into the weeds on broken contracts here for a second. There's two ways to measure it, right? So you can measure broken contracts by when they were broken, like how many contracts were broken in November, and you can have yourself a number. Or you can say, well, when was the contract signed? Was the contract signed in November, but then it was broken in, say, like January, February? And you can get a sense for how many contracts that were signed in November were broken eventually.
Okay.
Different ways of measuring it. Either way, the net result is about, in Manhattan, typically right now they average about 8% of contracts.
8%. All right. So 8%. Manhattan's at 8% broken contracts, given this crazy methodologies of how to track it, 15% national.
Yeah. So obviously there's a spike, right? Manhattan follows these spikes too, but we're not seeing that trend. So there's a trend here that obviously starts in 2022. What also happened then? That's when interest rates started rising. So I think you had an affordability crisis for a lot of folks, spike that first one, and it's just been kind of treading water since. We didn't necessarily see that. I think a lot of activity here just sort of, this market just, it went fallow for the last few years. So we don't necessarily see those contracts broken. The contracts that are coming across, cash contracts, those have a much, much higher likelihood of closing. So our breakage is half with the national average, that's kind of cool. Okay. Good job, Manhattan, Brooklyn.
It's a stability thing for Manhattan. It's all about stability. One question here from Maurice. I'm thinking that a declining job market, along with sticky inflation and a higher cost of financing debt, is not so good for the housing market. It's not good for the national housing market, that's for sure. We've mentioned that a whole bunch of times. Manhattan's just going sideways, but the national housing market went way up, and now it's coming down pretty much. A lot of rents, too. A lot of rents are coming down across the nation, but we live in this little bubble of Manhattan, and we see only what we see.
And Brooklyn.
That's what's going on.
Don't forget about Brooklyn. Don't sleep on Brooklyn.
I
forgot
about Brooklyn. Guys, let's just pivot back. I'm not going to make you watch Ross again, but let's pivot back. Okay. This is what we talk about on Friday, guys. We want to reference it really quickly. The evolving luxury threshold, top 10% of sales. Which way is that going in Manhattan, which is that orange kind of papaya line? You know, it's interesting. Right around the peak of the market in 15, 16 kind of thing, it just stopped going up. It just stopped going. They were following each other up for a while, and then it just stagnated. That's like kind of what price action did in Manhattan as well. It just kind of went sideways for a decade. But the Brooklyn luxury threshold continued to increase over that time. So it's very different, two different trends, Manhattan and Brooklyn, especially the last decade.
And just as a caveat, what does the luxury threshold mean? It means if you take the top 10% of sales and you figure out where that number, what dollar value are you now considering the top 10%? That's our luxury threshold. So we're just kind of tracking that over time. And it's interesting to see that basically the Manhattan market, that price appreciation for the luxury ones, and that the differential basically stopped. It's gone sideways. That's interesting.
Yeah, I think it's like
a lot of variation still, but it's
Yeah, I think the luxury threshold for Manhattan's like 4.2 right now, and I think for Brooklyn
it's right in there,
2.1 or something like that, like right half of it kind of thing. So good stuff over there, guys. We're back to Manhattan real estate over here, guys. Thank you so much for making it this far. I appreciate it. I know the holidays are coming up. Listen, if you're around tomorrow at 11 o'clock, we got our advisor special. This is our service that we offer. This is just a live Q&A. People asked us for this to describe what it is. So we're going to talk about it. We'll answer questions. We'll give you a little preview of what that is about in case you're in a situation and you need outside, independent, neutral, third-party help. And that's why this system, this service, I should say, is out there. We got Macro Monday the following week and price reductions to close it out. Tuesday, December 16th, price reductions. Yeah.
And we'll do a year-end review. And maybe some people asking for it next week, maybe Macro Monday. Next week's going to be super sized. And like some nice one.
I think we should do the year-end review like December 30th or something, right? Like it's a Tuesday. So either the 23rd or the 30th.
You have early stuff coming out. I mean, like I don't really want to work that hard.
All right, we'll figure out when to do a year-end review, but keep an eye on the calendar, guys. It might go light a little bit for the holidays, and then we'll be back here after the holidays. Right? But that's what's going on. Thank you very much. Thank you, guys. Thank you, John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and this has been Macro Monday, and we'll catch you next time. Cheers, everyone.
Thanks, everybody.